Hello and welcome. And what I'd like to cover during the next few minutes is something about what could happen in the coming budget. So Prime Minister Sir Keir Starmer says the October budget will be painful. So what does that mean? Well, with a claimed black hole from the outgoing government and a growing black hole from the current, Chancellor Rachel Reeves is on the lookout for additional revenues. So what does that mean to you and me? Well, let's consider some of the facts. Ms Reeves has approved £10 billion of pay rises since the new government was formed. The latest train drivers settlement probably ends up with more taxpayer subsidy, and the NHS needs more cash to pay its demands. The government has ruled out changing the main rates of income tax, value-added tax, VAT, and national insurance, as well as ruling out increases in the burden on working people. This leaves the prospect open on raising or changing taxes in several other areas. How? Well, pensioners, savers, and business owners could be a target. It also leaves open changing eligibility or incidence of the big taxes. We know there will be the imposition of VAT on school fees, an increase of taxes to be paid by non-doms, and an increase in windfall taxes. But what else might come our way? So have a think about that a second while I just have a swig of tea. So what else might come our way, do you think? Well, there are some options open to Ms Reeves, and while I do not have all the answers, and I certainly cannot read the minds of the government, I have reviewed and digested and inwardly processed many of the options available and can report on what I think could be included in Labour's tax plan. Number one, higher capital gains tax. Well, you probably realise that the last government had already eliminated most of the tax reliefs for modest levels of gains. And as a financial advisor advising my clients, this has been a painful realisation, and we've been making changes on an ongoing basis. And there's no longer any inflation indexing, so people are charged tax on changes in the nominal value, not the real value. The difference being nominal value is what it is, not the real value, which goes up with inflation and other cost increases. Some in the Treasury have wanted to impose the highest marginal income tax rate of the taxpayers on their capital gains and treat gains the same as income. This would be a substantial tax rise and would make the UK a less attractive place for savers and investors. Now, hold that thought for a minute, because I'll be coming back to that towards the end. Number two, of course, is reducing pension tax reliefs. Again, this is a painful way of raising tax, but it's not as obvious as VAT or income tax. The Chancellor could seek to reduce the amount of relief the better off enjoy through pension savings. There could be a lower limit placed on how much can be saved tax-free. Or the tax relief on the contributions to pension funds could be limited to basic rate tax relief, whatever the marginal rate of the taxpayer. That, of course, getting rid of the additional rate taxpayers and the higher rate taxpayers relief. The Treasury has often disliked the 25% tax-free cash withdrawal at retirement allowed. Now, and this could cancel or reduce that if they wished. Pension saving that survived the pensioners could cease to attract inheritance tax relief also. And this is a major change, or could be a major change, on the pension legislation. Number three could be an increased tax on expensive homes. There is a suggestion that the government might introduce a higher council tax band to increase the charge on owners for more expensive homes or second properties. There could be a further increase in stamp duties on such home purchases, which already attract a higher tax rate. Number four, changing tax reliefs for private equity. The government could change the rules over allowable interest to seek more tax from private equity managers and investors. The danger would be it could reduce the flow of private equity funds into the UK corporate sector. So think about that, because again, I'll be coming back to how this could affect the prospects of growth for the UK economy. Number 5, more taxes on fossil fuel vehicles and heating. Given the slow progress in getting people to adopt electric vehicles, EVs, and heat pumps, there might be a further move to increase car tax on more expensive petrol and diesel vehicles. There could be additional tax on gas or oil heating systems as well. There is a discussion of shifting the electricity levies to support renewable power onto general taxation away from electricity bills. Number 6, the carbon border adjustment mechanism. The government could go for a costly version of this proposed new tax. It takes the form of a tariff or tax on imported goods that have produced carbon dioxide in their manufacture and come from countries where there are no emissions or carbon taxes. Imports would generally become more expensive. Number 7, and interestingly, there could be a wealth tax. Labour has not promised its dream of a general low percentage annual tax on people's wealth over a certain sum. There has, nonetheless, been much discussion elsewhere. So it may be wise to remind ourselves of how it could work. A wealth tax would require taxpayers to make an annual declaration of their total net wealth. They would need to procure bank statements and savings statements of all deposits and funds held, and portfolio valuations from investment managers. The government would need to decide whether tax-free individual savings accounts, ISAs, and pension funds would be excluded from this legislation or included. Taxpayers would also need to provide a valuation of their properties and of any valuables or collections, from stamps and coins to artworks and other rarities. Cars and boats would need a mention too. If someone owns a private company and other unquoted investments, they too will need to be valued. This would represent a large annual burden to compile the information and satisfy the taxman that, where needed, independent and fair valuations had been procured. If the threshold for paying the tax was set too low, say 2 million or less, then someone living in a 2-bedroom flat in central London that they owned could face a large tax bill when they may have a low pension income and no other wealth. They would face a further tax for living in their own home. People running a small unquoted company, for instance, could also face difficulties if the company was not generating much free cash but was sufficiently valuable to put them into the tax bracket. People with, say, more than 10 million will be more likely to have more than one property and have deposits or financial assets which could be used to meet the levy. A typical approach would be a tax of 1% of wealth per year. Looking at the US Congress, for instance, they recently looked at the potential of a wealth tax, and it examined charging 1% a year on assets worth over 20 million and 2% over 100 million, with other permutations also considered. The idea was to keep the numbers of taxpayers involved quite small, whilst capturing large sums from those with multi-billions of wealth. This would maximise revenue in relation to costs, whilst minimising hard cases that did not have the cash to pay the bills. By the way, there are no proposals from the 2 US main parties to impose such a tax at present. And finally, a wealth tax is a good way of putting rich people off coming and settling into the country. You remember I said during going through this bullet points that I would come to how it could affect the UK's growth prospects. You see, if you put a wealth tax on various assets, right, and people who have that sort of wealth might think twice before coming into the country, and would encourage more better off people to look for an alternative, less intrusive and costly place to live if one was imposed. So people will also leave as well. The UK has already lost rich people through its non-dom tax changes. And I know that you may or may not be listening to me now and thinking, well, the non-doms tax isn't fair and they should be taxed. Well, whether I agree or not matters not. What is more important to look at is that non-doms do bring employment to the country, pay VAT through their businesses. So we need to be very careful not to get rid of the actual tax incentives too quickly, because that could, and don't shoot the messenger here, that could affect how much wealth is kept in the country and what the prospects are. For instance, no G7 country charges a wealth tax, and the leading world economic bodies do not recommend one. So I'm pleased that my opinion actually does actually fit with theirs as well. There are various other ways of taxing wealth which the UK and other G7 economies pursue. And moving on to number 8 now, land value tax is another grand tax reform scheme being discussed, and is imposing a tax on the value of land someone's home or business property occupies in place of business rates and council tax. And you know, business rates have come under some scrutiny in the past and continue to do so, as have council taxes. So, unlike a wealth tax, this will be a major reform and was not heralded in Labour's manifesto. So, leading up to the general election, there was no mention of it. So if they did this, this would be a big change. It is unlikely to be an early or easy way to more tax revenue, however, and the government has pledged to reform business rates at some point in the future. To avoid hard cases, any wealth tax would have to start at a high overall level of wealth of, for example, above £10 million. Given the above factors, there are likely to be tax rises in the budget on 30th of October. Combine this with the government's wish to spend more and their concern about the size of the deficit, rumoured to be over £20 billion, as I've already mentioned, it is quite likely these tax rises will be imposed on richer people and may well entail more taxes on buying, selling and holding real estate and financial assets. There are various changes they can make to reliefs and to rates for capital gains tax, stamp duties, council tax and inheritance tax. A full-blown wealth tax is less likely given the costs and complexities and the problems it poses for people with unquoted businesses or expenses, single homes who might not have the cash to pay the bills. To avoid hard cases, any wealth tax would have to start at a high overall level. And any major tax reform of wealth and property would usually be put to an extensive consultation before considering legislative change. Tune in to my live next week when I will be picking up on another topical issue to help you with your wealth, health and mindset goals. And of course, finally, remember to successfully become, visit joelteams.com. That's JOETEAMS.com. And until we meet again, have a brilliant day. Thank you.